The United States stock market is currently closed, and American Airlines Group, trading under the ticker symbol AAL, wrapped up its last active regular session on July 15, 2026 at 4:00 p.m. Eastern Time at a closing price of $15.63 per share, marking a slight intraday drop of 0.26%. While mainstream media outlines focus entirely on packed airport terminals, historically high summer passenger volumes, and premium ticket prices, the institutional capital tracking data reveals an entirely different situation under the surface. Millions of everyday investors are checking their mobile portfolios, assuming that record-breaking travel demand automatically translates into soaring equity valuations for legacy airlines. But smart capital is quietly pulling back from capital-intensive transports and reallocating funds into highly liquid tech giants, shifting weight into things like Nvidia stock or Apple stock. The broad expectation among retail market participants is that a travel-hungry public will inevitably propel corporate earnings back to structural highs. Yet the cold reality shows that structural cost inflation, massive balance sheet leverage, and industry-wide domestic seat overcapacity are actively destroying profitability margins. This tension between outward consumer behavior and interior corporate financial health creates a fascinating backdrop for anybody managing their own individual brokerage account or looking for strategic investment help. When you track the recent velocity of this equity, the immediate data points point to intense institutional friction. The stock has experienced sharp daily swings over the past several weeks, drifting steadily downward from its 52-week high of $18.79 toward the mid-$15 territory, a contraction that caught many late-stage buyers completely off guard. Trading volume has spiked well above the historical daily average of 99 million shares, occasionally clearing 180 million shares during intense distribution sessions, where large funds appear to be trimming their long exposure. If you look at the activity on major online investing platforms, there is a clear divide in how different market tiers are reacting to this price pressure. Retail accounts utilizing the basic Robinhood app or engaging in casual Robinhood stock trading have shown a high propensity to buy the dip, seeing a household brand name trading near historical valuation support levels as an obvious bargain. Meanwhile, highly sophisticated professional traders executing orders via the Interactive Brokers platform or managing substantial Interactive Brokers stock trading accounts are aggressively buying protective put options and positioning for continued pricing pressure ahead of the upcoming corporate reports. This deep divide brings us directly to the highly anticipated corporate earnings announcement, scheduled for July 23rd before the market opens, where Wall Street analysts have set a consensus expectation of just 4 cents per share. The whisper numbers across major trading floors suggest that even meeting this incredibly low bar will require the executive team to demonstrate substantial progress in cutting operational waste and stabilizing domestic yields. For anyone currently practicing self-investing or relying on modern automated setups like Schwab Intelligent Portfolios to guide their long-term capital allocation, understanding the structural mechanics of the airline industry has never been more vital. When unexpected capacity gluts occur, legacy network operations suffer far more than low-cost point-to-point alternatives because their fixed operational overhead is structurally massive. When regular consumer capital flows through ordinary individual checking accounts or into high-yield avenues like SoFi cash management, a growing portion of that discretionary consumer spending is being directed toward experiential travel, but airlines are finding it almost impossible to capture that value as net profit due to skyrocketing labor agreements and sticky jet fuel costs. Let us contrast this current market anxiety with the underlying business structure that American Airlines Group relies on to maintain its global footprint. Headquartered in Fort Worth, Texas, the company operates as a premier global network carrier, managing more than 6,800 daily flights across an extensive hub-and-spoke infrastructure that anchors major domestic air travel terminals in Dallas-Fort Worth, Charlotte, Chicago O'Hare, Miami, Philadelphia, and New York. The modern entity was established back in late 2013 through the landmark merger of AMR Corporation and U.S. Airways Group, a consolidation designed to extract massive operational synergies and create a dominant player capable of competing on the global stage. Over the past decade, management has deployed tens of billions of dollars into fleet modernization, resulting in one of the youngest mainline fleets among domestic network carriers. Yet this aggressive modernization came at a staggering financial price, leaving the enterprise saddled with a gross debt load exceeding $40 billion. When retail users browse modern investing sites or seek specialized online investment guidance, they often overlook this massive leverage, failing to realize that high interest rate regimes make refinancing this mountain of legacy debt an incredibly expensive proposition that siphons free cash flow away from common equity holders. Please take a brief second right now to interact directly with the channel by dropping your thoughts below. Comment below how many shares of American Airlines Group you currently hold in your portfolio right now, or if you are completely avoiding the legacy airline sector in favor of high-growth technology alternatives. Looking out across the broader financial landscape, the fundamental tension between market expectation and structural reality will continue to dictate where this equity trades as the year progresses. The optimistic market narrative assumes that as corporate travel sector steadily recovers and international premium traffic remains highly resilient, the airline will successfully leverage its young fleet to optimize fuel efficiency and drive high-margin loyalty program revenue through its credit card partnerships. The contrasting reality, however, is that domestic industry overcapacity has led to intense fare discounting in the main cabin, preventing the company from fully passing higher operating costs down to the end consumer. For long-term capital managers assessing their positions through comprehensive premium platforms like Fidelity Investments or selecting specific asset packages via Fidelity ETFs and Fidelity mutual funds, the primary challenge is determining whether the company can successfully transition from an era of aggressive capital expenditure to one of sustained debt reduction. Active participants using tools like the SoFi trading platform or adjusting their individual holdings inside specialized Fidelity IRAs must constantly balance these structural headwinds against the stock's undeniable deep value characteristics. Ultimately, the future path for American Airlines Group will not be decided by how many vacationers fill up regional flights, but by the executive management team's ability to maintain absolute pricing discipline and aggressively pay down their outstanding financial obligations. If the upcoming quarterly financial release shows a surprise expansion in operating margins or a meaningful acceleration in debt retirement, the stock could easily trigger a violent short squeeze, rewarding contrarian investors who scaled in using their regular SoFi active investing accounts or advanced interactive brokers accounts. Conversely, if capacity mismatches persist and labor costs continue to outpace unit revenues, the equity risks testing the absolute bottom of its multi-year support range near $10 per share, rendering generic valuation metrics completely meaningless. Navigating these turbulent macroeconomic waters requires investors to move past superficial headline numbers and closely monitor institutional distribution trends, options volume, and shifting sector momentum. By maintaining a clear analytical view that separates consumer enthusiasm from actual balance sheet productivity, you can make highly informed, objective decisions within your personal wealth management framework, regardless of whether you trade via a simple mobile application or manage a highly structured, fully customized institutional portfolio.